Capital Market Analytics introduces learners to data-driven analysis of financial markets and investment decisions. The course covers price momentum effects, portfolio analytics, derivative analytics, technical analysis, and trading strategies. It equips students with analytical tools to interpret market behavior, manage risk, optimize portfolios, and design effective trading strategies in dynamic capital markets. Price momentum refers to the empirically observed tendency of assets that have performed well in the past relative period to continue to perform well in the near future, and conversely, poorly performing assets tend to continue underperforming. It is a critical behavioral finance concept that challenges the traditional efficient market hypothesis. Momentum strategies typically exploit this persistence by buying past winners and selling past losers over typical time horizons of 3 to 12 months, offering potential excess returns beyond risk-adjusted benchmarks. The presence of price momentum effects indicates deviations from the Stroin form of market efficiency, suggesting that markets do not instantaneously and fully incorporate all information into prices. Behavioral biases such as investor underreaction, delayed overreaction, and herd behavior contribute to momentum. Momentum also implies that some investors might profit from predictable price trends, challenging the random walk hypothesis. Nonetheless, transaction costs and risk factors appear to temper arbitrage, allowing momentum to persist in the real world. Accurate measurement of risk and return is foundational to portfolio analytics. Expected return measures include mean historical returns and forward-looking estimates. Risk is commonly quantified via volatility, standard deviation, downside risk metrics such as value at risk, VaR, and beta, which measures sensitivity to market movements. Sharpe ratio and Sortino ratio provide combined risk-adjusted return metrics. Advances include conditional risk metrics and multifactor risk models that capture systematic and idiosyncratic risks more precisely, enabling more informed portfolio decisions. Modern portfolio optimization incorporates techniques from Markowitz's mean variance framework to more sophisticated methods such as Black-Litterman models, robust optimization, and machine learning-based approaches. These methods balance the trade-off between maximizing expected returns and minimizing risk under constraints. Optimization can incorporate multiple objectives including liquidity, transaction costs, and regulatory restrictions. Computational advances enable real-time rebalancing and scenario analysis for dynamic portfolio management. Evaluating portfolio performance uses metrics such as Jensen's alpha to assess returns relative to benchmarks adjusted for systematic risk, information ratio to evaluate consistency of excess returns, and tracking error for deviation from benchmark indices. Multi-period metrics like the Kamar ratio assess risk-adjusted returns over drawdowns. Attribution analysis breaks down performance drivers into asset allocation, security selection, and market timing effects to identify value added by portfolio management decisions. Derivatives include options, futures, forwards, and swaps, each with distinct payoff structures and use cases. Options grant rights without obligations, futures and forwards are binding contracts for future transactions, and swaps exchange cash flows to manage exposures. Applications cover hedging underlying asset risks, speculation, arbitrage opportunities, and portfolio diversification. Complex derivatives such as exotic options and credit derivatives expand functionality to tailor risk profiles and replicate exposures unavailable in spot markets. Valuation models for derivatives rely on no arbitrage principles and mathematical frameworks including the Black-Scholes-Merton model for options, binomial trees, and Monte Carlo simulations to price more complex instruments. Risk assessment employs Greeks to measure sensitivities to parameters such as underlying price, volatility, time decay, and interest rates. Stress testing and scenario analysis evaluate potential losses under extreme conditions, informing risk limits and capital allocation. Hedging strategies using derivatives aim to reduce portfolio risk exposures by offsetting potential losses, commonly using delta hedging for options or interest rate swaps to manage rate risk. Effective hedging requires balancing cost, basis risk, and liquidity considerations. Partial hedges can reduce volatility without eliminating upside potential. Empirical studies show well-implemented hedges enhance risk-adjusted returns and stabilize portfolio performance during market stress periods. Technical analysis is predicated on the assumption that all fundamentals are reflected in price and volume data, focusing on identifying trends, momentum, and reversal signals through charts and statistical indicators. Core tools include moving averages, trend lines, support resistance levels, and volume analysis. Technical analysis is widely used for short-term trading decisions due to its emphasis on market psychology and pattern recognition rather than intrinsic valuation. Popular chart patterns like head and shoulders, double tops bottoms, flags and pennants serve as predictive signals for trend continuation or reversals. Technical indicators include oscillators like RSI, MACD, and stochastic indicators that measure overbought or oversold conditions. Combining multiple indicators can improve signal reliability. Statistical studies show that certain patterns and indicators have higher predictive power in specific market conditions. Traders integrate technical analysis with risk management techniques including stop-loss orders and position sizing to formulate systematic trading strategies. Technical signals can be combined with fundamental analysis in hybrid approaches to validate trade entries and exits. Algorithmic trading widely incorporates technical indicators to automate decision-making. Effectiveness depends on consistent application, backtesting, and adaptation to changing market regimes to mitigate false signals. Trading strategies encompass diverse approaches. Trend following captures sustained price movements, mean reversion exploits price reversals to fundamentals, arbitrage leverages price discrepancies across markets, and high-frequency trading benefits from millisecond execution speed advantages. Each strategy requires distinct data inputs, risk profiles, and technology infrastructure. Hybrid and algorithmic strategies combine elements to optimize performance across different market conditions. Backtesting validates trading strategies on historical data to evaluate profitability, drawdowns, and risk metrics before live deployment. Robust backtesting addresses overfitting by using out-of-sample testing and walk-forward analysis. Performance analysis includes metrics such as CAGR, Sharpe ratio, maximum drawdown, and win-loss ratios. Backtesting also helps identify parameter sensitivity and strategy robustness under various market conditions. Effective risk management employs position sizing, diversification, use of stop-loss orders, and volatility-adjusted leverage to control drawdowns. Continual monitoring and adaptive mechanisms allow strategies to adjust parameters in response to regime shifts and changing market volatility. Risk budgeting allocates capital strategically across strategies to optimize risk-adjusted returns over time, enhancing portfolio resilience. In summary, mastering price momentum, portfolio analytics, derivatives, technical analysis, and trading strategies equips investors with powerful tools to optimize decisions and manage risks effectively. These key concepts and applications collectively enhance understanding and performance in dynamic capital markets, enabling smarter, data-driven approaches to investment and trading.